What does it truly take for a company to stay profitable for 150 consecutive quarters? I mean, think about that. Through multiple recessions, financial crises, even a global pandemic, it sounds less like a business strategy and more like finding a financial unicorn.
Right. It absolutely does. Yeah. That kind of consistent performance, defying major economic headwinds, it really speaks to an extraordinary underlying resilience and adaptability, too.
That's precisely what we're diving into today. Our mission, really, is to unpack the latest earnings call and financial report from Raymond James Financial. We're going to try and cut through the numbers and the jargon, delivering the most important insights, those aha moments, so you can quickly grasp what's driving their, well, remarkable success and what they're focusing on next.
Exactly. And our insights for you today are drawn directly from their fiscal 2025 third quarter earnings call. That features the CEO, Paul Shukri, and CFO, Butch Orlog. Plus, we've got their detailed press release, too.
Okay, so let's start with this truly incredible milestone. Raymond James has officially achieved 150 consecutive quarters of profitability.
Yeah. Nearly 4 decades. Consistent financial strength. It's clearly not just luck.
No, definitely not. It's really a testament to the power of their diverse businesses, how they complement each other.
Right. And Paul Shukri, their CEO, he emphasized this isn't just about weathering storms, it's about thriving. Always guided by their vision, which they state as being the absolute best firm for financial professionals and their clients.
You know, what's truly insightful here is thinking about how that long-term stability, especially through all the market upheavals we've seen, it disproportionately attracts a certain kind of client. Maybe folks less interested in, high risk, high reward strategies
Mm-hmm.
and more focused on preservation, consistent partnership.
Yeah.
If you're looking for a financial partner, knowing a firm has this kind of unwavering long-term profitability,
Mm-hmm.
well, it provides a strong foundation of confidence.
Sure.
It suggests they have the financial strength, the fortitude, to weather different economic cycles and keep investing and serving their clients effectively. And speaking of serving clients, this next point really highlights their execution. It's not just talk. Raymond James didn't just state a client-first philosophy. They've demonstrably delivered. They topped the J.D. Power rankings, #1 wealth management firm for advised investor satisfaction. I mean, how significant is that achievement in today's very competitive wealth management space?
Oh, it's immensely significant. And it includes being ranked most trusted and highest in specific metrics like people and products and services, which raises a crucial point. When advisors themselves are satisfied, and Raymond James also ranked highly in J.D. Power's advisor satisfaction surveys, both employee and independent.
Ah, interesting. Both sides.
Exactly. When advisors are engaged, they're more likely to stay long-term, they're better equipped with resources and support, and that translates directly into more consistent, high-quality advice and service for clients. It fosters stronger relationships and, ideally better financial outcomes for you. It's really a virtuous cycle.
It certainly highlights how their internal culture, like the CEO mentioned, directly impacts the client experience. Okay, so let's see how that dedication translates into the actual results. Let's turn to the latest financial snapshot. Third quarter, fiscal 25. Quarterly net revenues hit $3.4 billion. That's a 5% increase over the prior year.
Solid top-line growth.
Yeah, but pre-tax income saw a 13% decline, came in at $563 million compared to the previous year.
Right. And it's important to understand why. That decline includes a $58 million reserve increase. It was for the settlement of a legal matter related to bond underwritings way back from 2013 to 2015.
Okay, so a legacy issue.
Pretty much. The firm clearly stated they maintained strong defenses, denied liability, but chose to resolve it. Litigation can be complex, unpredictable. So this isn't really a core operational issue affecting ongoing performance, but more a specific one-time thing from a prior period.
That context definitely helps frame that Q3 number. So given that one-time settlement, does it suggest any broader vulnerabilities, or is it really just clearing the deck, so to speak?
It certainly appears to be the latter. If you zoom out and look at the year-to-date performance the first 9 months of fiscal 25, they've actually hit record net revenues, $10.3 billion. That's up 10% over the same period last year.
Okay, that's strong.
And record pre-tax income, too, $1.98 billion, up 5%. So these solid year-to-date results really underscore the strength of their diverse business mix: private client group, capital markets, asset management, and the bank. That diversification, it acts like a shock absorber. Even with a legal settlement bump, the overall picture remains pretty robust.
The shock absorber analogy makes perfect sense. Okay, and speaking of those diverse segments, the private client group, or PCG, really stands out. Looks like the core growth engine. Client assets under administration reached a record $1.57 trillion. That's an 11% year-over-year growth.
Yeah, huge numbers. And their PCG assets, specifically in fee-based accounts, also hit a record, $943.9 billion, up a very strong 15% year over year. And what's particularly compelling here is their recruiting momentum. Over the last 12 months, they brought in financial advisors with $336 million of trailing 12 production.
Okay, what does trailing 12 production really mean in simple terms?
It's basically the revenue those advisors generated in the previous year. So it gives you a strong indicator of the size and activity of their client base and business volume.
Got it. So significant producers.
Exactly. And these recruits brought in $52 billion of client assets just in their domestic independent contractor and employee channels. If you add in assets recruited into their RIA and custody services division, the total recruited client assets were over $60 billion across all their platforms.
That's a massive influx of assets and talent.
It really is. And their quarterly domestic net new assets were $11.7 billion. That represents about a 3.4% annualized growth rate. And they noted June activity actually picked up, showing high single-digit annualized growth.
So the momentum is building.
It seems so. The firm is actually seeing an acceleration in recruiting activity they haven't seen since the financial crisis, interestingly. Though, they did point out the advisors joining today are significantly larger, bigger books of business than in prior cycles.
Okay.
And it's also important to remember there's usually a lag, maybe 3 to 9 months, between recruiting an advisor and their assets fully showing up in the net new asset number.
Ah, right.
So this momentum we're seeing could continue to build in the reported figures.
So those big numbers we just talked about might actually tick up even higher down the line as these new assets fully transition. This also ties directly into what they call their best of both worlds value proposition, right?
Mm-hmm.
A culture that's deeply advisor and client-focused, but combined with leading technology and solutions. They also mentioned their strong balance sheet and commitment to independence are becoming key differentiators.
And this brings up a crucial point about their strategic investments. They're really focused on providing education, training, enhanced capabilities, particularly in the private wealth space for more sophisticated clients. I think they said around 370 advisors have completed or are enrolled in their specific private wealth advisor program.
Okay.
But at the same time, they're also making significant investments in AI, artificial intelligence.
That's a fascinating dual strategy. Investing in the human side, but also the tech. How does a firm that invests in both deep human connection and cutting-edge AI create a better experience for you, the client?
Well, it's really about synergy, right, and optimization. They seem to be using AI to drive operational efficiencies, things like automating routine tasks, streamlining data analysis, enhancing compliance checks.
Okay, the back office stuff.
Exactly. And the idea is this frees up advisors and their support staff to engage more human to human, to deepen relationships with you, their clients, focus on complex problem solving, strategic advice, and ultimately grow their businesses. So it's not about replacing the human element, but fundamentally enhancing it, making advisors more efficient and effective.
That makes sense. Using tech to empower the people. Now, while the private client group is clearly a major engine, it's crucial to understand how the other segments contribute to that overall resilience.
Yeah.
Let's maybe dig into capital markets first.
Sure.
Net revenues there grew 15% year over year, hit $381 million, driven by higher investment banking, fixed income, and equity brokerage revenues. They also mentioned the investment banking pipeline is strong, and the firm's becoming more optimistic about the macro picture, despite, ongoing uncertainty.
Yeah, and what's noteworthy there, particularly in fixed income, is that their business primarily serves banks and credit unions. They focus on helping manage securities portfolios for those institutions rather than maybe some of the higher volatility trading segments you might see elsewhere.
Ah, so a more stable client base there, too.
Generally, yes, it contributes to their overall consistent performance.
Okay. Then we have asset management, generated record pre-tax income, $125 million on net revenues of $291 million.
Very strong.
And they saw strong net inflows into their managed fee-based programs, annualizing at nearly 5%. That obviously complements the successful advisor recruiting we talked about.
Right, more advisors bringing in more assets into those programs.
And then the bank segment. Loans ended the quarter at a record $49.8 billion. And they said this is mainly due to strong growth in SBL securities-based lending, which is another synergistic impact, right, from the growing private client group.
Exactly. Advisors utilizing the bank's capabilities for their clients, and importantly, the credit quality of that loan portfolio remains really robust. Criticized loans, those showing potential weakness, stable at a low 1.14%. Non-performing assets where borrowers aren't making payments, also very low at 0.34%.
So very healthy loan book.
Yeah, signals very good management there.
And the bank's net interest margin, the IM, actually expanded to 2.74%. They said this was helped by a favorable shift in asset mix and lower cost deposits.
So looking across all these core segments, PCG, capital markets, asset management, the bank, were there any areas that significantly underperformed expectations, or is it truly a picture of pretty consistent strength?
Well, as I mentioned, the overall picture is strong, but the adjusted pre-tax margin for the quarter did come in at 19%. That's slightly below their stated target of 20%.
And they attributed that primarily to some softness they saw in capital markets earlier in the quarter. But they do expect improvement. They think a better capital markets environment, plus those continued tailwinds from the private client business, should help lift that margin. So
Yeah.
maybe more of a slight dip than a systemic issue.
Got it. That provides a balanced view.
Yeah.
Now let's talk about how they're deploying their capital. Their strategic flexibility. Their priorities seem clear. Invest in organic growth first, then look at strategic acquisitions.
Right.
And they have a pretty disciplined acquisition strategy, seeking opportunities that meet 3 specific criteria. Strong cultural fit, good strategic fit, where they said 1 + 1 gives us a chance of being more than 2, and valuations that generate attractive returns for shareholders.
And crucially, they aim to retain the management teams from the businesses they acquire.
That seems important for continuity, which raises a question. Why is such a disciplined approach to acquisitions rather than just, doing deals for the sake of size so important for a financial firm and ultimately for its clients?
That's a great question. A disciplined approach really ensures that acquisitions genuinely add value, that they integrate smoothly, and importantly, that they don't create unnecessary risk or, maybe worse, cultural clashes that could disrupt client service or derail that long-term growth focus.
Right.
It's really about strategic quality over just sheer volume, which at the end of the day protects and serves you, the client, much better.
Makes sense. And on shareholder returns, they were active there too. Repurchased $451 million of their common stock during the quarter. Average price was about $137 per share.
Yeah.
Year to date, they've returned over $1 billion to shareholders through dividends and those share repurchases.
That's significant capital return.
And their capital strength looks impressive. Total assets at $84.8 billion. Corporate cash sit at roughly $2.3 billion, which they noted is well above their $1.2 billion target.
So that gives them significant flexibility for future growth, maybe more acquisitions if the right ones come along.
Okay, looking ahead now, what's the outlook? For investment banking, the firm believes the next 2 quarters should be better than the prior 2. They're citing more positive market sentiment, maybe some pent-up demand from motivated buyers and sellers, especially private equity sponsors. Apparently, they represent about 60% of Raymond James's M&A activity.
Yeah, that PE connection is key for them. On the recruiting front, the environment remains highly competitive, particularly with those private equity-backed roll-ups firms buying up smaller advisor practices offering really aggressive packages.
Still a challenge then.
It is, though Raymond James did note the tone from some of these firms might be shifting a bit, perhaps becoming less aggressive. It's hard to say. But what's interesting is that Raymond James continues to see broad-based success across all their affiliation options, employee, independent, RIA. It's not just tied to one specific market catalyst.
Suggests their core value proposition is resonating.
I think so, yeah.
Okay, what about client cash balances? They saw some seasonal dips early in the quarter, tax payments, fee billings.
Standard stuff.
Right. But balances increased by nearly $1 billion in June alone. And those new advisor affiliations are expected to be a tailwind, bringing more cash onto the platform going forward.
Makes sense. More advisors, more clients, more cash potentially.
And looking at emerging trends, what about digital assets? Crypto, stablecoins, that whole area.
They're cautiously monitoring it. That was the clear message. Particularly stablecoin strategy. They seem encouraged by the potential for regulations to eventually catch up to the demand and interest out there.
But cautious is the key word.
Absolutely. Their primary focus remains on protecting clients until a really clear regulatory framework is in place. They explicitly said they are not bleeding edge in this space, but they are studying it closely so they can be responsive to client and advisor needs when the time is right. It feels very consistent with their long-term client-first philosophy. Prudent.
Right, not chasing the hype. And finally, they mentioned Canada. still committed to the Canadian market.
Yes, very much so. Investing in resources there, like a new technology system. And they remain open to acquisitions in Canada, but adhering to those same strict criteria we discussed earlier: culture, strategy, value,
Okay.
all of which really points to continued strategic, disciplined growth, reinforcing that remarkable profitability streak.
So wrapping it up, we've seen how Raymond James Financial continues this really impressive streak of profitability. It seems driven by that client-first culture, strategic investments in both technology and advisors, and a disciplined approach to growth, all adding up to 150 consecutive profitable quarters.
Indeed. It's a clear demonstration of how a deeply focused strategy combined with operational efficiency and strong relationships can lead to truly uncommon consistency in the financial world.
And that leaves us with a provocative thought for you, the listener, to consider. In a world of constant change, nonstop information, what does it truly mean for a financial firm to be client first? And not just say it, but consistently deliver on that promise quarter after quarter, 150 times. And maybe thinking ahead, how might their strategic investments in areas like AI or their cautious but engaged approach to digital assets, how might that reshape the future of financial advice for you?